You've got this increasingly joined up attack on tax avoidance, which is perceived by most tax authorities in the Western world now as no different to tax fraud. And the courts seem to be right there behind the revenue in terms of knocking out one aggressive tax scheme after another. But it's not all not good. We've got a corporation tax rate which at its worst is 28% and it's going to fall at 1% a year for a few years. We've got a bonus from this government in terms of capital gains tax for entrepreneurs, with entrepreneurs relief effectively giving you 10% on the first £5 million of gains and 28% on the rest. And that's a lot better, isn't it, than 50% plus 13.8% national insurance. When you're looking at planning your affairs in this environment, you do need to balance risk and reward. For most entrepreneurs, the company is part of your overall personal family wealth. You don't need to plan for the company in a vacuum. You can afford to look at your whole personal situation and plan your affairs accordingly. Retaining the profit in the company actually is not a bad idea. It's going to give you the minimum tax rate, and you can build up the profit in the company and ultimately extract it via the capital gains tax regime. If you're 3 or 4 years away from a trade sale, say, why would you pay yourself big dividends or bonuses at those tax rates? Why not retain the money up at corporation tax and then sell the company with the cash in the company and pay capital gains tax effectively by selling the cash pound for pound as part of the share sale? Don't forget estate planning. I talked about the planning for the entrepreneur being a holistic approach, taking into account all of the taxes, and estate planning is a key factor here. When you sell your trading company, you start with shares in a trading company which are effectively exempt from inheritance tax because they qualify for business property relief, and the minute you turn it into cash, you've got yourself a liability at the rate of 40% on whatever the sale proceeds are when you die. There are certain kinds of securities that you can issue which are linked to an index which, let us say, could be net asset value, it could be share value, it could be any kind of matrix that you want. And provided the index goes up over the life of the security, at the end of the life of security, it automatically unwinds, the company pays out, the individual pays capital gains tax, and the company gets a corporate tax deduction. So it's very similar to a bonus, although it is not a bonus because it also has the potential to fall in value, as all securities should. So we have here limited company with some commercial property on it. If you sell that property and you want to take the money out, the effective rate is 54%. You pay corporation tax on the gain inside the company and then another 36% say on the dividend, which gives you an effective rate of 54%. But if instead you take that property and you pay it, the property itself, as a capital contribution into a limited liability partnership, you can effectively move the property into that partnership without any tax in the company, without a stamp duty land tax charge. Any debt stays in the company. Company retains an entitlement to today's value of the property, and the fact that it's receiving the rental income will enable it to continue to service the debt, because most people's property portfolios have gone down in value over the last year or two in the light of the current economic environment. So the value is depressed. So when this capital contribution comes across into here, you've got opportunity for much more capital growth because of that depressed value that's in the company at the moment. There are so many people, so many entrepreneurs who haven't got wills. It never ceases to amaze me. Here's a classic scenario for an entrepreneur. Cash and the company, 1.1, 1.6 million. If that entrepreneur dies, how much is exempt? People will tell me it's £325,000 because that's the nil rate band. If you think that's the case, then that's what you'd do. You'd leave £325,000 here. That would be a taxable transfer, but effectively it's covered by the nil rate band, and the rest you'd leave into a trust for the wife and possibly do something with it, assuming she survives for long enough after her husband has died. There's a quirk in the legislation which increases the nil rate band if you draft the will correctly, which does that where you have business assets. And in that example, the nil rate band is nearly £800,000. So there's an opportunity with a fairly simple piece of will drafting to increase your nil rate band significantly. I think aggressive tax avoidance is probably not for the faint-hearted. It's probably not even for the brave-hearted these days. What we want, or what we should be looking at, is a longer-term strategic plan to minimise tax leakage across all of the taxes. and as far as the estate planning point is concerned, don't leave it too late.